$300 a month, every month for 40 years, inside a Roth IRA at a hypothetical 9% a year. That comes to about $1.2 million. And when you take it out, the IRS takes nothing. Not on the dividends along the way, not on the growth, and nobody telling you when you have to start withdrawing. That's the version of this account most people have heard. Here's the part they haven't. There's a rule inside a Roth IRA that decides whether any of that actually reaches you tax-free. And most people who think they know it are thinking of the wrong one. There are two of them, they share a name. Only one of them catches people. And over 40 years, the wrapper you choose beats almost any stock you'll pick. Quick disclaimer first, this isn't investment advice and it's especially not tax advice for your situation. Tax law is where a one-size-fits-all explanation gets people in trouble. Your income, your filing status, what state you live in. All of it changes the answer. So talk to a qualified accountant before you open or contribute to anything. I'm walking the framework as I use it. Use the framework. Don't use the specifics without checking. So, what is a Roth IRA mechanically? It's a retirement account defined under Section 408A of the tax code. If you ever want the source document, it's IRS Publication 590A. What makes a Roth different from every other retirement account is the order of the tax. You pay it on the money going in. You pay none on the money coming out. Contributions come out of your take-home pay after the IRS has already had its share. Once the money's inside, every dollar of growth, interest, dividends, capital gains goes untaxed. And when you withdraw in retirement, if you followed the rules, you owe nothing. A traditional IRA is the same deal running backwards. You get the tax break going in, and you pay ordinary income tax on every dollar you take back out. So the bet you're making with a Roth is that you'd rather pay tax on the seed than on the harvest. And for a dividend investor, that bet has a sharper edge than it does for most people. So, who's allowed to open one? And how much can you actually put in? The annual Roth contribution limit for 2026 is $7,500 if you're under 50, $8,600 if you're 50 or over. That's the standard limit plus an $1,100 catch-up. Both move with inflation now, so they'll be a little higher in 2027. That cap is per person, not per account. 3 Roth accounts don't give you 3 limits. And unused capacity doesn't roll forward. If you don't fill this year's, it's gone. There's also a floor most explainers skip. For a beginner, it's the one that actually bites. You can only contribute if you have taxable compensation, wages, salary, self-employment income, money you earned, and your limit is the lesser of $7,500, or what you earned that year. Earn $4,000, and $4,000 is your ceiling, no matter what the headline number says. $7,500 spread across 12 months is $625 a month. Exactly. On this channel, I contribute $300 a month, a bit under half the maximum. That's deliberate, and there's no minimum here. $50 a month works. $600 works. The framework is identical either way. Only the size of the ending number changes. So that's how much you're allowed to put in. Now, whether you're allowed to put in anything at all. The income limit, this is where the Roth gets fiddly. The IRS restricts Roth contributions for higher earners, and the thresholds depend on how you file. For 2026, if you're single or head of household, you can make the full contribution up to a modified adjusted gross income of $153,000. Between $153,000 and $168,000, the amount you're allowed to contribute shrinks on a sliding scale. Above $168,000, you can't contribute directly at all. Married filing jointly, that same window runs from $242,000 to $252,000 of combined income. And there's a third case that blindsides people. If you're married filing separately and you lived with your spouse at any point during the year, your phase-out window runs from $0 to $10,000. 0. And it has never been adjusted for inflation. Unlike every other number in this section, it doesn't move. If you're over the limit, there's a workaround people use called the backdoor Roth. You contribute to a traditional IRA, then convert it to a Roth. It's allowed. And it's common among high earners. It also drags a second 5-year clock in behind it, which is exactly where this is going. Which brings me to the rule this episode is actually about. The Roth IRA is the wrapper that makes dividend investing tax efficient across decades, which means the wrapper decision sits upstream of every stock decision you'll ever make. If that's the kind of thing you want more of, hit subscribe. It genuinely helps. Same framework every test, real positions on the record. The 5-year rule. Rules, plural. There are 2 of them. They're both called the 5-year rule. And mixing them up is how people end up paying a penalty they were certain they'd avoided. Start with the one most people mean. Your Roth contributions. The money you put in, what it can come back out at any time. No tax, no penalty, no waiting. You already paid tax on those dollars. The IRS has no further claim on them. Your earnings are different. The dividends, the interest, the growth, everything the account made on your behalf. To pull those out tax-free and penalty-free, 2 conditions both have to be true. 1, you're at least 59 and a half. 2, 5 tax years have passed. Both, not either. If you're 60 and the account is 3 years old, the earnings are taxable. If the account is 10 years old and you're 40, the earnings are taxable. And they take a 10% penalty on the way out. Now, when does that clock actually start? Because this is the part that gets stated wrong constantly. It does not start the day you open the account. It starts on January 1st of the first tax year you made a contribution to a Roth. Any Roth. And it's 1 clock per person, not 1 per account. So if you contributed to a Roth back in 2019 and closed it, then opened a brand new one this year, your clock started in 2019. Those 5 years are already behind you. That's rule 1. And if that's the one you already knew, it's the other one you need. Every Roth conversion starts its own separate 5-year clock. Every single one. Move money from a traditional IRA into a Roth, including by that backdoor route I mentioned, and that converted money is on its own timer. Independent of the account's timer, and independent of every other conversion you've ever done. Take it out inside those 5 years, and you can owe the 10% penalty on it. Even though it feels like your own money going back out. Even though the account itself might be 20 years old. One exception worth having straight, because the internet routinely gets this backwards. Once you're past 59 and a half, that penalty stops applying. Age is its own listed exception. So the conversion clock is a live problem for someone converting in their 40s and planning to spend it in their 40s. It is not a problem for someone converting at 62. 1 clock for the account. A fresh clock for every conversion. That second one is the real reason the backdoor Roth is a conversation with an accountant, and not a checkbox in an app. Both rules exist for the same reason. To stop people treating a retirement account like a checking account, which raises the obvious question. If the money has to sit there for decades anyway, why fill it with dividend stocks specifically? Because of 3 things that stack. 1, no income tax on the dividends as they're paid. In a taxable account, every dividend is reportable income for that year, even if you reinvested it and never saw the cash. Inside a Roth, nothing. The dividend arrives, it buys more shares, and none of it lands on your tax return. Your custodian files a form telling the IRS the account exists. That's Form 5498, but nothing on it is a tax you owe. 2, the qualified dividend rate stops mattering. In a taxable account, qualified dividends are taxed at 0, 15 or 20% depending on your income, plus a 3.8% surtax once you're high enough. And notice that 0. Early in your career on a modest income, the taxable account might already be costing you nothing. This argument is weaker for you than the internet claims. It gets strong later when your income has grown and every one of those payments is being skimmed. In a Roth, it's 0 at every income level, in every year, forever. 3, no required minimum distributions. A traditional IRA forces you to start withdrawing and paying tax on those withdrawals at 73 today, rising to 75 for anyone born in 1960 or later. Which, if you're watching this, is probably you. A Roth has none of that during the original owner's lifetime. Nobody makes you sell. So a dividend stream inside a Roth compounds at the full rate, every payment, every year, with nothing taken off the top. And the higher your tax bracket climbs, the wider that gap opens. Which is why the next number is as big as it is. So, the math. $300 a month, every month for 40 years. That's $144,000 of your own after-tax money going in. At 9% a year, that grows to about $1.2 million. 9% being broadly the long-run historical return of the S&P 500 with dividends reinvested. One note on how I'm running that. I'm compounding once a year on a year's worth of contributions. That's the conservative version. Compound it monthly, the way an account actually credits, and the same inputs give you closer to 1.4 million. I'd rather show you the smaller number and let reality beat it. And it's a hypothetical, not a forecast. Nobody is promising 9%, including me. Now shorten the horizon. This is the part that should change how you think about starting. 30 years instead of 40, about $490,000. 20 years, about $184,000. The last 10 years of that account add more than the first 30 combined. If you're starting late, don't panic, but do understand exactly what you're protecting and what breaks it. Back to the promise at the top. That number only exists if the compounding runs the full distance. 3 habits protect it. 1. You don't take the dividends out as cash. Every payment gets reinvested into more shares. Most brokerages will do it for you automatically. Switch on dividend reinvestment, DRIP, and forget about it. 2. You don't touch the earnings before 59.5. That costs you income tax, it costs you a 10% penalty, and then it costs you the thing nobody puts on the statement. That money never compounds again. The tax, you can calculate. The 40 years of growth you just canceled, you can't. 3. You don't trade it. Inside a Roth, there's no tax cost to selling, and that's exactly the trap. Nothing stops you, so people do it, and mistimed exits and re-entries quietly drag the real return well below the 9% the whole thing is built on. Let the 4 rules of the Main Street test decide what goes inside. That's the one thing right. That's the wrapper. $7,500 a year if you're under 50. An income limit that depends on how you file. 1 5-year clock for the account, and a fresh one for every conversion. And a tax bill of 0 on every dividend the thing ever pays you. Every episode on this channel runs a stock through the Main Street test. This one was about where those stocks actually sit. If it was useful, hit subscribe. It genuinely helps. And tell me in the comments which Roth Edge case you want next. Conversions, spousal contributions, or what happens to the account when it's inherited. Whichever one gets asked most is the one I'll build. I'll see you in the next video.